stock, we need to sell to someone who is buying. If you wanted to purchase 2,000 shares of a particular stock at $7, there has to be sellers with 2,000 shares available to be sold to you at $7. If there is only 500 shares at $7, then you would only get filled 500 out of your 2,000 share order at $7. So you have to ask yourself, what is more important to you, getting all 2,000 shares filled or getting filled at the exact price you want? You may be thinking, well, I want both. Yes, I would love both too, but in fast-moving markets where prices and number of shares available are constantly changing every second, it becomes difficult to have both, which is why we would use different order types for different situations. Depending on the broker you choose, you may have many different order type options, but the most common are market orders, limit orders, stop loss orders, and stop limit orders. The market order is used when you care more about getting all your shares filled rather than the exact price you pay. When placing a market order, all you need to do is type in the number of shares you want and hit the buy button. Your broker will get you all the shares you specify while also attempting to get you the best possible price, but that price may not be what you were hoping for. Once you click that buy or sell button using a market order, your order will be executed immediately. Remember, since we are buyers, we have to get shares from someone who is selling. So from our previous example, let's say that you placed a market buy order for 2,000 shares, and at that exact moment, the current price was $7. You may be hoping to get all 2,000 shares filled at $7, but if the best price at that particular moment was $7 and there was only 500 shares available, you would get 500 shares at $7. But the rest of the shares may get filled at $7.01 or $7.02 because those are the next best prices that the shares are ready to be sold at. Your order will keep buying up all the shares available at each price level until all 2,000 shares are filled, causing you to have an average price, which may be over the $7 price that you were hoping for. When this happens, this is called price slippage. Slippage can be very dangerous if the price difference between each level is very large. This happens when stocks experience high volatility and are also less liquid, trading on low volume. So if we were trading these types of stocks, we need to eliminate as much slippage as possible. And the best way to eliminate slippage is to use a limit order. A limit order is used when you care more about the price rather than the number of shares you want. When placing a limit buy order, you would specify the number of shares you want, the price you want it for, and then hit the buy button. Your order will be queued up, but it will not execute until a seller is willing to sell you shares at the price you specified. Your broker will fill your shares at your specified price or better, but they cannot guarantee all the shares or even any of the shares will be filled at your specified price. Let's say that the current trading price of the stock is $7.60, and you only wanted to buy if the stock comes down and reaches $7. In this case, you would use a limit buy order set to $7. Your order will be sent to the trading floor, but it will not execute until the current price comes closer to $7 and that there is a seller willing to sell you shares at $7. Remember, since we are buyers, we have to purchase shares from someone who is selling. So from our previous example, let's say that you place a limit buy order for 2,000 shares at $7, and the current price at that exact moment is $7. You may be hoping to get filled all 2,000 shares at $7, but if there's only 500 shares available at $7, you are only going to get 500 shares out of your 2,000 share order, leaving you with a partially filled order. Unless more shares become available to be sold to you at $7, you will only get 500 shares out of your original 2,000 share order. Stops are used as protection from losing on a trade. A stop loss, often just called a stop, will turn your order into a market order once a trigger price is reached. To make this type of order, you would enter the number of shares and the price that you want a market order to be triggered. You can use stop orders for either buying or selling, but we'll use a sell stop order for our example. Let's say that you did acquire your full 2,000 share position at $7. But instead of the stock price going up as you planned, it goes down and is currently trading at $6.86. You have already decided that if the stock reaches $6.80, that you will take the loss and move on to another trade. By placing a stop-loss sell order at 680, your sell order will not execute until the price reaches 680, in which your order will turn into a market sell order. Notice that now we are selling our shares, we have to sell them to people that are willing to buy them. The best prices that are willing to be bought at this time is 500 shares at 680, 500 shares at 678, 1,000 shares at 677, and 400 shares at 675. So your broker will sell all the shares available at each price level until all 2,000 shares are filled. So you'll sell 500 shares at 680, you'll sell another 500 shares at 678, and then you'll sell the rest for 1,000 at 677, leaving you with the average fill price below the $6.80 that you were hoping for. Just like a stop loss, a stop limit will not execute until a trigger price is reached, but instead turn your order into a limit order. So just like the previous example, let's say that you were holding a position of 2,000 shares at $7, hoping that the stock price goes up, but it doesn't. It falls to 686. You have decided that if it goes below 680, then you want out and you will take the loss. By placing a stop limit order at 680, your order will not execute until 680 is reached. Since stop limits are limit orders, you are guaranteed the price but not the fill. So here is where it can get really dangerous using a stop limit order as protection. If the price drops quickly to 680, you may only get filled 500 shares out of your 2,000 share order. If the price continues to fall, you are stuck holding 1,500 shares because there is no one wanting to buy your shares at 680, leaving you with a partially filled order on a losing trade. Using stop limits as protection from a losing trade can be risky because of the chance of you not getting completely out or even you not getting filled at all. So I would not use stop limit orders as protection, and I'd rather take the risk of slippage from a market order instead. The only time I would use a stop limit order would be when buying a stock. A situation where you would use a stop limit buy order would be to purchase a stock using a limit order above the current trading price. If the current trading price was at $7.28 and we see it come into a major resistance level at $7.50, we could maybe predict that if it broke above that $7.50 level with lots of buying strength, then it would have potential to skyrocket. So maybe what we would want to do is place a limit buy order at $7.51 so that we can catch the break to the upside. If we were to place a regular limit buy order and set it to $7.51, our broker is going to give us the best possible price at that moment, which is currently $7.28, given that there's shares at that price. So we need to tell our broker, hey, we only want to buy this stock if it breaks over $7.51. So in this case, we would choose to use a stop limit buy order for 2,000 shares at $7.51. Now you can do this with stop loss buy orders as well, but keep in mind stop losses are market orders, which puts you at risk of slippage, and breakout spots such as this have a high degree of volatility, causing lots of slippage. Stocks can sometimes move very quickly. After entering into a trade, we could be needing to take profits seconds later, so it's important to eliminate as much time as possible having to type in orders. This is why I recommend using a broker that has the option to program hotkeys. Hotkeys allow you to program specific keys on your keyboard to place certain order types. For example, I have programmed Alt-V to buy 1,000 shares using a market order, and I've programmed Alt-D to sell my entire position using a limit order. I also have a hotkey to place a stop sell order 10 cents below my entry price. Depending on your broker, you can get really granular programming your hotkeys. You can pretty much program any order type with any number of shares at any price you want on any specific key you want. If I didn't have hotkeys, I would be late entering and exiting positions at the prices I wanted, so they are crucial when it comes to day trading. As always, I hope you all learned something. Thank you so much for watching. Depending on which broker you choose, you should have the option to configure different windows for tools. You should be able to pull up a charting window, a level 2 window with time and sales, an order entry window, an order history and pending and active orders. This is my trading software layout. I have 3 different softwares at one time. This right here on the left is my broker. Down here is a separate scanner from a different company, and then the charts are a separate scanner from a different company. To understand what level 2 data is, we'll first go over what level 1 data is. If you ever looked up the current price of a stock, you've probably recognized that there are 2 other prices close by. These are pending limit orders, which is currently the best price that someone is willing to pay for the stock and the best price that someone is willing to sell the stock. The price on the left is called the bid, which is the buyer side. And to help me remember this, I always think of bid and buyer both start with the letter B. The price on the right is called the ask, and this is the seller side. The numbers next to these prices are the number of shares that are available at each price, and these are shown as a multiple of 100. So this one right here is 100 shares, and this one right here is 100 shares. And these numbers are a collection of all shares available. It could be one buyer with 100 shares or 100 buyers with 1 share. So in our example here, the best price that someone is willing to pay for the stock is at $3 for 100 shares. And the best price that someone is willing to sell the stock is at $3.04 with 100 shares. If we wanted to use a market order to purchase this stock right now for 100 shares, the best price we could get it for is $3.04. Remember, since we are buyers, we need to buy from someone who is selling. Let's say that we have already owned this stock and we want it to sell using a market order. The best price that we can sell it for is at $3. Since we are selling, we have to sell it to someone who is buying. Now, the bigger price is the last transaction price and has nothing to do with the price you are able to buy or sell the stock for. Now, a little side note that I want to point out here is that it is extremely important to be aware of the difference between the bid and the ask price. If we wanted to purchase the stock right now, we would get it for $3.04. But if we wanted to turn around and immediately sell it, the best price we can sell it for is $3. So this automatically puts us down 4 cents on the trade. This difference in price is called the spread. And sometimes stocks can experience spreads ranging from 20 to 70 cents or higher. Usually spreads are higher when stocks are experiencing low volume and are illiquid. So be careful when stocks are experiencing large spreads because they can significantly increase your risk. So back to our main topic here, level 2 data expands level 1 data, which allows us to see more prices beyond the current best prices. This will allow us to see more depth of the limit orders placed at certain prices with the number of shares at each price. By viewing this information, we can see ahead of time of possible opportunities or problems. So the very top row here is the level 1 data, and it shows the best price that someone is willing to sell the stock for, which we see is $3.04 for 100 shares, and the best price that someone is willing to pay for the stock, which is $3 at 100 shares. So if we expanded our level 1 data, it shows all the different limit orders that have been placed at each price, along with the amount of shares available at each price. All the buyers are on the left side column. This shows all the pending orders with the amount of shares at each price that are below the current best price. All the sellers are on the right-hand column. This shows all the pending orders with limit orders placed above the current best price with the amount of shares next to them. The letters on the left are the electronic communication networks, also known as ECNs. These are the systems that connect brokers and traders together so that buy and sell orders can be matched. Now, knowing what these do in greater detail isn't necessarily important for the purpose of understanding level 2. In fact, I don't even pay attention to these, but I think that knowing what they are can help you understand of how the market works, which will be another topic for another day. The different colors you see, such as dark purple, pink, and blue, mean nothing more than just to help you visually see prices grouped together. Notice how all the 294s are in this blue area and all the 308s are in this pink area. Now, depending on your broker, you can change these colors to whatever you want or change it to one solid colored if you like, but I think that having different colored groupings like this help you see it more clearly. Looking at level 2 can tell you a lot about the sentiment between buyers and sellers. By looking at the number of shares, we can see ahead of time of possible support and resistance. So resistance is always going to be shown in terms of sellers, and support is always going to be shown in terms of buyers. Now, looking at this level 2, I can see that we're probably nowhere near a major support and resistance level because there's not that many shares being shown at any one of these prices. The highest share price that I see is 1,400, and that's not really that significant. But if we were watching level 2 as it was coming into a major level on our chart, we can identify that by looking at a large number of shares sitting at the price that we've drawn. So looking at the chart on the right, we can see the stock testing a major resistance level located at $3.90. We can confirm that on level 2 by noticing how many sellers have orders at $3.90. In order for the stock to break up past $3.90, those sellers either have to cancel their orders or the shares need to be bought up. We can see if the shares are getting bought by looking at the time and sales window located on the right side of level 2. Now, most brokers will give you a separate window just for the time and sales. While level 2 will only show you limit orders waiting to be executed, the time and sales window will show you orders that are actually being executed in real time, showing at which price, how many shares, and at what time. If the order is highlighted in green, that means the order was executed on the ask. If the order is highlighted in red, that means the order was executed on the bid. If it's white, then the order executed somewhere in between the bid and the ask. So level 2 may seem like the golden tool to fix all your trading problems, but it's not 100% reliable because traders are able to hide actual order sizes. For example, a trader can place a 5,000 share order but choose to only make 100 shares visible on level 2. Traders do this to not spook the market by placing large order. So there's really no way to see how many exact shares are at each price, which is why you can't just rely on level 2. Level 2 just gives us a better understanding of what's going on and should only be looked at once a good chart pattern is formed with high volume. The chart pattern is what makes a good trade. Level 2 just helps us see if it will work out or if it will fail faster. So as always, I hope you all learned something watching this video. Thank you so much for watching. $10, but your losers average out to be $100. You're still a losing trader. So by putting the focus more on risk rather than the reward, you will make your winners bigger than your losers. Successful day traders all have one thing in common. They are good at being losers. I hear some traders say, the loss isn't real until you sell. That is the logic that has traders hold on to their losers too long, hoping that their loss will turn around to a winner, but only to watch their loss get bigger and bigger and bigger because they didn't want to lose in the first place. No one wants to lose money. It's a horrible feeling, which is why selling a loser is a lot harder than you think, because once you have sold the loser, the loss becomes real. Also, it can be really frustrating to sell at a loss only to see minutes later that the stock turned around and you could have profited. The reality is that selling a small loser, no matter what, is no big deal. The quicker we sell that loser, the faster we can move on to the next trade with a clear head and make our money back. If we let our losers get too big, rational thinking starts to diminish, and we start acting more on emotions. We may get frustrated and add to a losing position, or may try to revenge trade after a big loss, or take on more risk by trading with larger size on the next trade to try to make everything back. These are huge mistakes that can wipe out an entire account. It took me a long time to get used to cutting losses quickly because I never wanted to lose. I held my losers longer than I should have, which caused some unnecessary big losses. It took time to practice, but you have to be good at losing by accepting the fact that you were wrong on the trade. Every trade should have a fixed max loss per trade, and every day should have a fixed max loss per day. On every trade I take, I have a predetermined max loss on that trade just in case if I'm wrong. And this amount is always constant. My max loss on every trade is $100. It's not $100 on one trade and $300 on another. It's always $100. Your max loss should be something you are very comfortable with losing. By defining your max loss before making the trade, it will make it much easier to take the loss if you are wrong because you've already accepted the amount you're risking. If you don't define this max loss before entering a trade and the trade goes sharply against you, you may not accept the loss, and it may cause you to hesitate to cut it shortly. It may cause you to make detrimental mistakes such as holding on to an increasing losing position or averaging into a losing trade. Now, I could be wrong on every single trade I make on a particular day, which can get really frustrating because it has happened before. Losing does not feel good, and I know that if I'm losing, I am not in the best mindset to keep trading. So, in case this happens, I have a max loss per day. I have a setting through my broker that prohibits me from trading if I am down more than $400 in one day. This forces me to call it quits and then come back fresh the next day. Having a max loss per trade and a max loss per day is going to force you to keep losses small. It's also going to keep you from revenge trading or taking on more risk by trying to dig yourself out of the hole. Now, here's a quote I found by Bernard Baruch, which is something I cannot agree more with. It's not about how much you make, but how much you don't lose. That is the mindset you need going into each and every trade. Focus on the risk, not the reward. There is no trading strategy that produces over 100% wins. In fact, being right over 75% of the time is pretty difficult. I'm usually only right 50% of the time, and I'd say that the majority of other traders are too. So accepting the fact that you will be wrong almost half of the time is why this concept of risk-reward ratios is extremely important. On every trade you make, your profit target should be at least the same amount as your max loss per trade. If I was risking $100, I would want to start taking profit once I'm up $100. This is what we call having a risk-to-reward ratio of 1 to 1. Your risk is the same amount as your reward. Having a risk-to-reward ratio of 1 to 1 allows you to be right 50% of the time and still break even. Now, unless your win rate is higher than 50%, then you won't make money using a 1-to-1 risk-to-reward ratio all the time. My win rate is around 50%, so I need to always aim to try to get a risk-to-reward ratio of 1 to 2 or higher. So on every trade, I risk $100 to try to make $200 or higher. This is how I'm able to make money being right only 50% of the time. And for me to just break even, I just need to be right 33% of the time. The bottom part of this graph, this green area right here, is a positive risk-to-reward ratio. This is where we want to be because it allows us to have more losers and still be profitable. Staying in this area is more forgiving, and it can also take away a lot of stress in trading. You want to be in this area because you will make mistakes that cause you to make losing trades. We are human and mistakes happen from time to time. Even the best traders in the world give in to FOMO or break their trading rules or give in to fear from time to time. So by allowing yourself to have room for error by not needing to be right on every trade will help you stay profitable. The top portion of this chart is a negative risk-to-reward ratio. This is where trading can get really stressful because you have to maintain a high win rate just to break even. Having that pressure to have to win on every single trade can lead you to make mistakes such as holding losers too long or not accepting the loss or adding to losing positions or revenge trading and so on. Stop losses are what we're going to use to protect ourselves from a losing trade getting out of hand. A stop loss is the certain price where the trader sells for a loss when reached. This is the price at which you sell once your max loss per trade is reached. Each trade should have a stop loss placed around recent support or resistance. So that means you need to be buying and selling around support and resistance. This is going to be what keeps you from getting stopped out all the time. The best place to put stop losses when taking a long position is underneath strong support levels, because if a strong support level breaks and the price drops lower, that is when a long position does not make sense anymore. If you were taking a short position, you would place your stop loss just above resistance, because if resistance breaks and the stock price pushes higher, a short position would no longer make sense. I found that only buying around support and selling around resistance is the easiest and most predictable way to trade. Your share size should be based on the distance between your stop loss price and your entry price while keeping in line with your max loss per trade. Before I enter a trade, I go through a 4-step process in order. First, I determine my exact amount I'm willing to risk. Next, I determine where my stop loss should be. Then I determine where my entry price will likely be. Finally, I'll calculate the number of shares I need to take to abide by my max loss per trade amount. That may sound confusing, so here's an example. Let's say that we see a stock coming into a support level of $10. We're predicting a bounce off of the support level. So before going into the trade, I need to determine 4 things. What's my max loss that I'm willing to risk on this trade? I want to risk $100. So that's already predetermined. Next, I need to determine my stop price. Well, a good place to put a stop is right below a strong support level. We see that support is at $10. We're going to make our stop price at $9.90 to kind of give some room just in case if maybe the stock drops 5 or 6, 7 cents below support. So we want to give about a 10-cent stop below support. Next, we need to determine where's our entry price likely going to be. Well, we don't want to set a limit order or place an order right at $10. We want to wait for confirmation that the stock will maybe bounce off of the level. So we get the bounce, and then we're most likely going to buy this thing around 10.10, which would give us confirmation. So what is our difference between our stop and our entry price? It's 20 cents. So that is putting us at 20 cents at risk. If we want to abide by our max loss, if we were wrong on this trade, how many shares do we need to take? We would take 500 shares. So here's the math of doing this. If we're risking $100, how far away is our stop from our entry? So our stop is already predetermined. We said our stop is at $9.90. What's our entry likely going to be? Entry is going to be $10.10. That's 20 cents. So we're risking 20 cents. Is the reward of 40 cents likely based off of technical analysis? Now, you have to look at the chart. You have to kind of determine, is 40 cents likely? Because we want 40 cents because this is going to be double our risk. Depending on what the chart looks like, if there's resistance above that's maybe a dollar away, then 40 cents will be likely. But if there's resistance maybe 10 cents away, we don't want to take that trade. We want to make sure that the reward is definitely obtainable and it's double what we're risking. So if that's the case, then we'll take the trade, and then we have to do some division to figure out our shares. So what we're going to do is take the dollars at risk. So we're risking 100. We divide that by the cents at risk, 20 cents, the difference between our stop and our entry. That will equal our share size. So in this case, it equals 500 shares. Now, this may seem confusing and it takes a long time to figure out, or you may need a calculator, but the more times you do this, you'll find that you'll use the same numbers over and over. You already know what your max loss is, or the money that you're willing to risk, and you'll find that you usually risk the same amount of cents. I usually only risk 10 or 20 cents depending on the volatility of the stock. So I know I will always be using 1,000 shares if I'm risking 10 cents, or 500 shares if I'm risking 20 cents. Now, I want to go back to this 4-step process right here. When I started out trading, I did the exact opposite of this 4-step list, and I see a lot of other traders do it too. They would first determine their share size, and then enter into the trade at the price they wanted. Then once they are in the trade, they determine their stop price, at which is some random number of cents at risk. This is going to make your stop loss on the trade some unknown number, which could be much bigger than you anticipated. Doing this will cause you to likely hesitate on taking the loss if you were wrong in the trade, and this will increase risk and also mess up your risk-to-reward ratio system. Here's an example of managing your risk using a chart pattern. This is going to be a strategy that I teach you coming up, so I'm not going to get into the details of it, but let's just say that we're looking at this chart pattern and we only see what's highlighted in this blue area. Everything in this dark gray is something in the future. We can't tell what it's going to do. It hasn't happened yet. So we're just looking at this pattern right here. So we're looking at the stock, it's breaking through this 350 resistance area, and then it's coming back down to test that resistance as support now. So we're eyeballing the stock and we say, hey, I want to buy this if the support level holds. So how would we determine our risk getting ready to take the trade? Well, first, we already know what the amount we're willing to risk. We want to risk $100. And then the second thing we know is, where's our stop going to be? Our stop is going to be below the support. So we are waiting for confirmation that this previous resistance is going to hold as support, and we get that confirmation by getting these 3 candles, 1, 2, 3, not breaking down below 350. So we say, okay, this 350 level is holding. We're going to put our stop just below 350. So we'll put our stop at 349. You should probably maybe put it at 340 just to give it a little bit more room, but in this example, we're going to put it at 349. So As this is pulling back down, we need to constantly be thinking where our entry price most likely will be. Do we want our entry price to be 10 cents above 349 or 20 cents above 349? Where is our cents at risk most likely going to be in terms of the difference of our stop and our entry? So we're going to determine that our entry price is most likely going to be at 369. This is going to be 20 cents. We need to determine our share size before we jump into the stock. And to do that, we have to do a little bit of math. If we're risking $100, what's the difference between our stop and our entry? It's 20 cents. We're most likely going to get this at 369. Our stop is predetermined at 349. That's a difference of 20 cents. So we take the dollars we're willing to risk, divide that by 20 cents. This is going to be 500 shares. So we're going to take this trade, 500 shares at $3.69 with a target of $4.09, because that will be double the difference between our entry and our stop, giving us a 1-to-2 risk-to-reward ratio. So we talked about managing risk for losing trades, but we also need to manage our risk from losing profits on our winning trades. It's common to hold on to a winning position only to see your winning position turn into a losing position just because you didn't sell. You have to realize that the market is unpredictable and that you can't know for sure how far a stock will move in your favor. But at the same time, we can't cap our winners short in fear of giving back our profits because we need to at least obtain a risk-reward ratio of 1-to-1. The best way to do this is to scale out of winning trades with predefined profit targets. By doing this, we are locking in profits as the stock is moving up and at the same time holding on to some shares for the potential big moves. Once I'm in a trade, I know exactly where I'm going to start selling my position. I like to sell at possible resistance areas, and I'll sell in half sizes. So, for example, if I took a 1,000 share position and it rises to my first profit target, I'll sell 500 shares and then change my stop price to the price I originally bought in at, which would keep me at break even for the remaining of the shares. I'll keep selling half of my position at possible resistance areas on the daily chart while also raising my stop loss for the remaining shares if the stock continues up. So by doing this, I'm giving myself a chance for the remaining shares to keep rising for bigger profits while also maintaining zero amount of risk. This is when I'm in the driver's seat and I'll make money on the trade no matter what. Here's an example of how I would scale out of a trade. Looking at a similar setup as we saw before, we get the break above resistance and we're looking for it to test as support. It holds as support as we see on these two candles and we enter on the first candle to make a new high. So $7.40 would be our entry price. Our stop would be just below the support, so we'll call it $7.20. That's a 20-cent stop. If we're risking $100, then we'll take it for 500 shares. So we let the trade work out, and our first profit target is at the next daily resistance level, which is $7.88. We wait for the stock to come up near that level and sell half our position. So we'll sell 250 shares, and once we sell that, we immediately adjust our stop to our entry price back here at $7.40. This gives us money on the trade no matter what the stock does afterwards, because we've already locked in half the position, we already locked in our profits, and the remaining of the shares are at break even. So by doing this, we're giving a chance for the stock to maybe try to break through 788 and continue higher where we can scale out even more. But in this case, it doesn't. It starts to fall back down right here, in which case I probably wouldn't let it get to my stop at break even. I would predict that this is going to be the top of this move right here because we get these big pullback candles right here and it breaks below the 9 moving average. So this is just a sign to say, hey, we're probably going to come back down and test this support. So there's no real reason to just let your stop get hit if it's unnecessary. But let's say that the stock did break through this 788. It breaks through the 788 and then curls back down to find some support at 788, just like the pattern back here. Once it did that, you would then adjust your stop to below 788. So you want to keep adjusting your stop below new market structures that the stock is making, such as support or swing highs and swing lows. It's important to understand that not all the time is a stock going to make this move right here and then rise up to the next resistance where you can sell. Sometimes it'll make it just halfway and then fall back down. You're not always going to get a 1-to-2 risk reward ratio, sometimes not even a 1-to-1. But as soon as the market gives you an exit indicator, such as it breaking down below a 9 moving average or breaking a new low off of a swing low pattern, then it's probably time to get out. That is risk management. I hope you can see how important it is to your trading. And if you just follow the risk reward ratio system, trust in the system, know that you can take losers. Losers are not going to be a big deal as long as you try to make your winners bigger than your losers. So I hope you all learned something. Thank you so much for watching. It's just the movement of a stock's price. And by analyzing this movement compared to past price movement, we can gain certain clues about what the price may do in the future. In order to understand price action, we need to understand how the market moves. They don't go straight up or straight down, they move in waves. And these waves are what give us the swing highs and swing lows that we learned about in Lesson 4. While the markets move in waves, they also move in trends. There are 3 types of trends a stock could trade in. The first is a sideways trend. You see how the swing highs are not any higher or lower than the previous swing highs, while also the swing lows are not any higher or lower than the previous swing lows. This is a downtrend. Notice how the swing highs are getting lower and the swing lows are getting lower. If we placed a resistance line on the top of the swing highs, our line would be pointing down. Also notice that the candles are trading below its moving averages. And the final one is the uptrend. This is the direction we want to be looking for when taking trades to the long side. You see how the swing lows are increasing as the stock price is going up, while also the swing highs are increasing. And if we took a support line and placed it at the bottom of the swing lows, our line would be pointing up. Another way we can identify an uptrend is noticing the candles trading above the stock's moving averages. Identifying the trend is the very first thing we look at when looking at a stock's chart because we want to be putting the probability in our favor of producing a winning trade. Stocks tend to continue in the direction of the overall trend. A common saying in the industry is, the trend is your friend. If the overall trend is up, then you should be taking long positions. If the overall trend is down, then you should be taking short positions. It can be tempting to try and trade against the trend, but by doing so, you will most likely have less reward potential while also increasing your risk. This type of trading is called counter-trend trading. But the overall trend does not last forever. Trends will be broken and new trends will form, causing the waves you see in the market. So how can we tell when one trend ends and another one is about to begin? Let's take an uptrending stock here as an example. An uptrending stock will have increasing highs and increasing lows. And when this pattern of increasing highs and increasing lows break, we would typically start to see a reversal that will begin a downtrend. Here in the blue box, we get the first candle to break below the previous swing low, and thus begins the pattern of decreasing swing highs and decreasing swing lows. Trading in the direction of the trend is going to put the probability of making a winning trade in your favor. But in order to grab the most reward while minimizing our risk, we need to make buy and sell decisions based on the waves the market gives us. And being able to anticipate when a new wave will start to form up or when a wave will start to form down will give us better entries and exits. We don't want to be buying at the top of waves as a long trader. We want to be buying at the bottom of the wave before a new wave starts to rise. And one way we can anticipate when a wave up or down is about to end is reading how the candlesticks are shaping and also plotting their highs and lows. Here we have 2 long-bodied candles moving the price up, thus creating an up wave. If you remember back in Lesson 3 of this course where we talk about candlestick shapes, these long-bodied candles mean that buying is strong with lots of momentum to go up. Notice here on the candle on the right, it has a higher high based off of the previous candle, and it also has a higher low based off the previous candle. This tells us that an uptrend has begun. But at this point, we do not want to be buying as we have already missed the proper entry point. We need to be patient and wait for a downwards wave to form so that we can get in before another upwards wave such as this starts to form. On the next bullish candle, we get a higher high and a higher low based off the previous candle. This is still continuing the uptrend. But notice how this candle is smaller than the last two candles. This is indicating that the buying momentum is slowing down and the start of a downwards wave may be getting close. Now we get the first red candle starting the downwards move. It's the first candle to make a lower high and a lower low based off the previous candle. So is now the time to buy? No, because we do not know at this point how far this downwards wave could go. It could possibly drop all day long at this point for all we know. So in order for us to place a buy order, we need to be patient and wait for a new wave upwards to begin. And one way to do that is to wait for the downwards candles to get smaller, showing that the downwards momentum is slowing down. And once they start to get smaller, we can anticipate that this is the bottom of the downwards wave and that a new upwards wave will start to form. But at this point, we do not want to be guessing that this is the bottom. We need to wait for confirmation before placing a buy order. And to get that confirmation, we would wait for the first candle to make a higher high based off the previous candle. This is where we would initiate a buy position. Notice how the start of the new wave has a longer bodied candle showing the momentum to start the new wave back to the upside. Not only can we look at the candle sizes to anticipate the start or the end of a wave, but plotting the trend of the candle highs and the lows will help us confirm the move. When we combine market waves to an uptrending stock, we get what are commonly known as bull flag patterns. Bull flag patterns have strong upwards moves followed by what we call a pullback. We call it a pullback because once a stock makes a strong move, it typically pulls back to a market structure such as a moving average, a trend line, or a support or resistance line coming from the daily or an intraday chart. We would then initiate a buy position once we have confirmed that the pullback has completed and the move will resume back up. One way to look for high probability bull flag patterns is to look for stocks that have made strong moves up and then have small pullbacks on light volume towards one of the market structures just mentioned. Once we have identified a stock moving strongly to the upside, we need to wait patiently for a pullback to get a low risk entry. This particular stock has just broken through resistance and continuing higher. It may be tempting to buy right here thinking we are missing out on the move, but remember, we are at the top of the wave as well as near a resistance level. We need to wait for a pullback to find support at the previous resistance, then make a new wave upwards. So now is when we get the first pullback candle. Once we get the first pullback candle, we need to be taking note of each candle high and seeing if the next candle will break above it. The next candle forms, but it does not break the previous candle high, so we do not buy. But notice that the bottom of this candle did not go below the previous resistance line, which could signal that this may change to support. Now we get the first candle to break the previous high, confirming that the uptrend will continue, and thus we enter into a buy position. Ideally, we would want our entry price to be just above the previous candle high, and we would place our stop just below the support line. So let's look at a pullback using a real chart. Here we have a stock that has made a strong upwards move. Notice the long candled bodies. Also notice the increasing volume. This is telling us that the buyers are interested and are pushing the price higher. Now we need to be patient for a pullback to form. We get the first pullback candle, but we need it to come closer to a market structure, such as a moving average or a support line. Since there is no identifiable support or resistance line nearby, the moving averages are the next best market structure. Notice the decrease in volume as we are getting this pullback. This is telling us that there is not much selling pressure on the way down, which is exactly what we want to see. We get a second pullback candle on even lower volume. Notice how the next pullback candle is even smaller than the previous. Here is when we need to start getting ready to take a buy position. As the pullback candles are forming, we need to be noting what the high of the previous candles are, so that if the price breaks above the previous candle high, we can have our buy order ready. This candle high is at 638. So if we start to see the price break above 638, that is when we would want to place a buy order. The next candle forms, but it does not break 638. It gets a high of 637. So now we need to wait to see if the next candle breaks 637 and then place our buy order just above it. Even though this candle body is a little bit bigger than the previous candle body and that we are not quite at the moving averages, we can assume that we are getting close to the end of this downwards wave because of the decreasing volume. And on the next candle, we get the break of 637. Where would our entry most likely be? 638. Where would we place our stop? Just below the low of the wave, or just underneath the red exponential moving average at 622. The bull flag pattern is not a perfect setup. In fact, no trading pattern is guaranteed. So there will be times when this pattern creates a false break, meaning we'll get a candle to break the previous candle high, but the price falls shortly after. That's why we want to manage our risk accordingly. Where you'll see false breaks the most is in faster time frames, such as the 1-minute chart, which is why I always suggest beginners to start with the 5-minute time frame instead. As a beginner, it can be extremely hard to stay patient and wait for 5-minute bull flags to form because you'll be looking at your computer for several minutes not doing anything, which may seem like you are missing out on a lot of opportunities if you would just look at the 1-minute chart instead. The problem with the faster time frames, such as the 1 minute, is it gives a lot of false signals and is a lot harder to read. Here's the chart on the same stock on the same day, but the chart on the left is the 1-minute chart and the chart on the right is the 5-minute chart. Notice on the 1-minute chart that these bull flag patterns are rigid, and you don't get nice clean breaks to the upside once you get the first 1-minute candle to break the previous pullback candle high. But over here on the 5-minute chart, you get much cleaner setups, which help reduce the possibility of false signals. Notice inside the red box over here on the 1-minute chart, we get what looks like a perfect bull flag pattern to form. We get the break of resistance, and price comes back down to hold as support. We start getting 1-minute pullback candles to break the previous candle highs, but it doesn't go. We end up falling down through support. This is a false breakout. But if we were only looking at the 5-minute chart, we notice we don't get the break of the previous candle high. So as you can see, the 5-minute will give more confirmation than a 1-minute chart. As you get more practice and experience, you'll be able to make more advanced trades by looking at a faster time frame such as the 1 minute, but if you are a beginner, trading a slower time frame such as the 5-minute will be much easier. In the next lesson, I will be showing you a live recording of one of my trading sessions. This live session will tie everything you have learned in this course together and apply it to real-time trading. I will be trading the bull flag pattern while also explaining the price action in real time. This video will be over 30 minutes long, so make sure that you dedicate enough time to watch the entire thing through. As always, I hope you have learned something, and I want to thank you so much for watching. The root of all their difficulties lie within these 3 behaviors, and the reason that this is so difficult to realize is because of how our brains work. Our brains have 2 systems for making decisions. The first system, we'll call this the I system because this is driven by instinct or a learned reaction based off of prior experience. It's what makes us move our hand away if we touch something hot. It's what makes us duck from a flying object. In other words, we don't have to think to make a decision. It's just a fast, automatic, and unconscious way to make decisions. But this type of thinking can be prone to errors because it's so fast. This is also where all of our emotional responses come from. The second system, we'll call this the A system because this is an analytical way of thinking. It's driven by reason or logic. This system can make complex decisions, but it is slow and takes effort, therefore giving us more reliability. When it comes to trading and making decisions, most of us think that we are always using our A system to make our decisions, but when trading in real time under financial pressure, we use our I system more often than not. And to get this point across, I want to give you a popular 3-question cognitive reflection test designed by Shane Frederick. Now, I want you to pause the video, read the questions, and write down your answers. And try not to take more than a few minutes because when day trading in real time, you're not going to have very much time to make decisions as well. So go ahead and pause the video and I'll come back. Okay, do you have your answers? Each of these questions uses our I and A system in some way or another. The answer to question number 1 would seem to be 10 cents if our I system was more dominant, but if we were using our A system, we would find that the correct answer is going to be 5 cents. For question number 2, our first reaction is to say 100 minutes if our I system was in control. But with a little help from our A system, we would find that if it takes 5 machines 5 minutes to make 5 widgets, then the output is actually 1 widget per machine per 5 minutes. So if there were 100 machines, it would take only 5 minutes to make 100 widgets. And for question number 3, the I system would say that the answer is 24. But a little help from our A system would tell us that if the patch doubles in size every day, then the day before it covers the entire lake, it must have covered half the lake, so the answer is 47 days. Now, if you only got a few of these right, or even none at all, don't worry. When Shane Frederick first administrated this test to 3,500 people, he found that only 17% of people got all 3 questions right. Now, this test is not to see if you are smart enough to trade stocks. It's just to help you realize that a lot of trading decisions stem from our I system, even though we think we are using our A system. The I system will be where most of our trading mistakes come from, such as hesitating, changing our risk, jumping the gun, selling a winner too soon, or holding a loser too long. Even if you try to justify the reason to make these mistakes in some rational way, the origin still stems from the I system. Have you ever made a dumb mistake on a trade and you look back and you say, what was I thinking? Why did I do that? That did not make any sense. I should have done this. That is because our A system is only dominant when we are not in a position. Once we enter into a position, or we start to get close to enter into a position, that is when our I system starts to become more dominant, and this is where most of the mistakes happen. So by acknowledging that us humans are prone to this type of decision making under pressure, we need to put ourselves in a mindset that eliminates as much I system thinking as possible. So let's start out with the first behavior that causes traders to fail: focusing on the reward. We all drew an interest to trade stocks for one thing: to make money, right? It seems to be a fast and easy way to be able to afford that new Maserati or quit your 9-to-5 job. Our eyes are easily fixated on the prize. That's why so many traders jump right in using real money, because they want the rewards as soon as possible. But when it comes to reward, it's something we can't really predict. We can have a good idea of where the stock may be headed, but there's no guarantees it will get there. We can't wake up every morning and say, I need to make $200 in the market today, because there's no guarantees the market will provide you with a good opportunity, yet alone $200. When you are always thinking about the reward, you are always putting focus on the unknown, and it's impossible to predict the unknown. But what we do know is how much we can risk. We can wake up every morning and say, today I want to only risk $100. If the market takes my money, so be it, because I have already accepted the amount I'm willing to lose. If I'm right and the market gives me $200, that's great. So let's say that for every trade you risk $100 to make $200. A common problem traders have is not giving their trade a chance to reach up to $200. They take their profits way too early before any indication to sell. Now, why would they do this if they are focusing on the reward? Wouldn't they be holding on to their position to get a bigger reward? That's what the A system would tell us. But once we are in a trade, our I system would tell us to quickly take $20 because maybe we are happy with $20 and we don't want to lose it. After all, a winning trade is better than a losing trade, right? Well, not necessarily. Winning trades are only good if they are bigger than our losers. If we take 5 $20 winning trades in a row, we may feel like we are excellent traders because winning feels good and we predicted a profitable outcome 5 times in a row. But all it would take is one $100 loss to wipe out all of our winning trades. By focusing on losing that small $20 reward, you are ignoring the risk of taking a big losing trade that will wipe out your gains. This is why risk-reward ratios are so important. Risk comes first, not the reward. The second behavior that will most likely cause traders to fail is believing that they can predict the market. Now, this may seem like a contradiction because how else are we going to make money if we don't try to predict what the price will do next? We do need some sort of analysis that will help us determine what the price will do next, but where most novice traders get into trouble is that they expect their analysis to be correct. I see traders all the time mismanage their risk by going all in on a stock or adjusting their risk in a position because they are expecting a certain outcome from their analysis. Maybe the chart setup is perfect. Maybe the news is spectacular. Maybe everyone in the media is predicting the same thing. But the problem is the markets have no rules or boundaries. They are completely free to do whatever they want. Just because a chart pattern is perfect or all the professional analysts are saying it's a home run does not guarantee the trade will work out in your favor. When you believe something will happen, you are also expecting it to happen. When you expect something to happen and it does the opposite of what you are expecting, it's easy to not accept that you were wrong. Because being wrong does not feel good. When you are wrong on a trade, all that hard work, all that analyzing, all that research, and all those fantasies of closing out that big winning position was for nothing. When you don't accept the reality that you were wrong, it will be extremely easy to try to come up with reasons to become right so that your hopes and expectations are not completely shattered. This is when your I system is going to start to kick in. You will be trying to come up with ways to be right. You may think it's rational to add to a losing position even though the trend has completely reversed on you. Or you may hold on to a losing position because you still believe that your first prediction will become true. Maybe you just mistimed it. This is not rational thinking. This is emotional thinking because you are not accepting you were wrong on your initial prediction. This will lead to your losses becoming huge and your winners becoming small, which will eventually lead to your account becoming zero. The rational decision in this situation is just to accept that you were wrong, take a small loss, and move on to another trade that could wipe away that small loss and possibly give you a profit. It's impossible to predict the market with certainty. All we can do is analyze the probability that our trade will work out. When we think in probabilities and not expect anything, then it will be much easier to accept that our trade just so happened to take the portion of the probability that was not in our favor. And by determining our risk beforehand, it should not be a concern if we were wrong. No matter how good you are at reading charts, no matter what combination of indicators you use, no matter how perfect the trade setup seems to be, you will never be able to predict what the markets will do every single time. There are just too many factors that you can't possibly know in order to predict the market's future. Every trade pattern will have a completely different and random outcome than the last result. Let's take the bull flag pattern that we talked about in lesson 8, for example. You identified a perfect bull flag setup holding strong support, and you bought at the perfect moment and you sold, hitting your profit goal. Now let's say a day later you identified the same bull flag pattern on the same stock at the same price and you bought at the perfect moment, just like last time. You predict that the stock will rise to meet your profit target goal, only this time the stock drops and you sold for a loss. Why did the bull flag pattern not work out the second time? It was identical to the first. You did everything right. You waited for the right moment and bought at the best price. What happened? The pattern may be the same, but the people trading the same pattern are completely different from the last pattern. You have a completely new number of traders using different strategies, using different share sizes, and they all have different levels of experience. Every single pattern is unique because every group of traders trading that pattern is unique. This is why the market is unpredictable because it's impossible to know the details of each group of traders looking at the same pattern. So if each pattern is unique and each outcome is completely random, how can we know if a stock will work out in our favor? The answer is to start thinking in probabilities. We can't know for sure if our trade will be a winner, but we can have an idea of the probability of what that particular pattern produces. Under the right conditions, and if traded correctly, the bull flag pattern has a win rate of about 65%. We know that if we took 100 bull flag trades, that we will win 65 times. And if we follow and stick to our risk to reward ratio of 1-to-1 or higher, then we will make money just trading the bull flag pattern. Knowing the probability and cutting our losses when we are wrong is going to be crucial to your success. This kind of logic is coming from our A system. And always reminding ourselves that if we take trades that have a probability higher than 50%, and when we are wrong, we make the loss small, and when we are right, we let the winner ride, we will keep our I system from taking over, making it much easier to accept that our wrong predictions are okay. As soon as you start trying to expect something, that is when you're going to make mistakes. It's funny because just this morning before making this video, I made a mistake of trying to predict a pullback that kept me from taking my profits when I should have. There were clear signs I should have exited the trade, but I was expecting the stock to pull back to this yellow support line, then continue higher. Now it did pull back, but instead of curling back up, it kept dropping down, causing my winning trade to become a losing trade. It was that expectation that made me hesitate on taking my profits. You need to go into every trade with no expectations. If you don't expect to win or a certain dollar amount gain on the trade, then it will be easier to exit the trade once an exit signal presents itself and just accept whatever the market gave you. The third reason traders fail is acting on fear. Most of the mistakes you will make will come from fear-based decisions. Every time you sell a winner too soon, every time you hold a loser too long, every time you jump the gun too early, you are acting on fear, even if you try to come up with, and I'm doing air quotes here, a logical reason to make those types of decisions. I was watching a live trading recap of a trader who cut his winners extremely short in the trading session. The video was made on a day during the last week of the year, the week between Christmas and New Year's Eve. Now, for anyone new to trading, this can sometimes be a difficult week to trade because this is a week many traders take time off, thus providing low volume and high volatility in the market. But during this particular week, we had some of the best trading that year. I asked this trader why he sold his winners too soon. If he would have held on to his winners like he normally would have, then he would have had an excellent day. He responded that it was a holiday week and he wanted to reduce his risk trading during this time. I then told him to try and not let fear alter your trading plan. He then responded that he wasn't scared. He just made a calculated decision since he traded during this week in previous years. Now think about this for a second. He made a calculated decision based on prior experience. Maybe last time he traded during this week, he took some bad losses. Maybe he made some good winning trades, but then gave them all back. So for this year, he thought the rational thing to do is to immediately take profits once he was up so he can reduce the risk of having a red day. Now, at first glance, this does seem logical, but if you take the time to think about it, this is actually an eye system decision based through the emotion of fear. Why did he cut his winners too short? Based on past experience, he was afraid of giving back profits. So what's the logical decision to be made here? We previously learned that each and every trading pattern, or really each and every trading day, is completely unique. It does not matter what has happened in the past. Every trading situation is completely different. You should be taking each trade as you normally would no matter what past experience you have because past performance does not reflect future performance. Now, I understand the reason to be concerned trading during this holiday week, so it's okay to try to reduce the risk. But the logical decision is not to cut your winners short. The logical decision is to adjust your max loss per trade to something you are comfortable with during that week. Maybe normally you risk $100 on each trade. So for this week, you can adjust your max loss to $50 per trade. You want to be adjusting your loss potential, not your reward potential. If this particular trader would have let his winning trades ride, he would have probably had the best trading week of his entire career, as this particular week provided some of the best setups out of the entire year. But because he acted on his eye system, it cost him huge potential. You'll notice a lot of beginner traders make big gains started out. Maybe they made 20% or more their very first month of trading. Maybe you were one of those traders, which got you hooked onto trading. I know I was. This is common because they have no negative experiences to associate the market with, and therefore don't let fear make their decisions. Looking at this monkey in the snake picture, maybe this monkey is seeing a snake for the very first time. This monkey has no negative experience with snakes and therefore isn't afraid to get close to it. But if this snake bit him, I'm sure this monkey will never get close to another snake again, as long as he didn't die from the bite, of course. But just like our experienced trader who we previously mentioned, if he had never had that negative experience during the holiday week in prior years, I would bet that he would let those winners ride for big gains. But because of that negative experience, he adjusted his plan and cut his winners short to make sure he got a winning trade. When you are just starting out trading, you are fearless because you have no negative experience to cause you to fear anything. And the reason you make big gains is because you are fearless. But the more you trade, the more negative experiences you will have. The more negative experiences you have, the more you try to analyze and study the market to reduce as much negative experiences as possible. The more you study and analyze the market, the more you think that each decision you make is the most rational decision. When we lose on trades, that creates pain. Our brains do everything to avoid pain, so we try to think of ways to block out that pain. And we block out that pain by changing our strategy to try to become right. This is the point where most traders get stuck and never become profitable. They adjust their trading based off of past experience. Even though they think this is rational thinking, it's actually fear-based thinking. If they cut a winner too short, they do so because in the past they had a winner turn into a loser. If they held on to a loser too long, it's because in the past they sold for a loser only to see later that they would have profited if they just would have held. If they jumped the gun too early, it's because in the past they missed out on a huge opportunity. All these decisions are fear-based, no matter how rational you try to make them. Fear has no place in stock trading, and it's the number one reason why so many day traders struggle with cutting their losers quick and letting their winners run. Once you learn to not be afraid is when you will start profiting. But learning to trade without fear is no easy task. The whole reason we have an I system is to quickly act on fear. It's what protects ourselves from potential pain or danger. If someone who was standing right next to us were to suddenly, without warning, throw an object at our face, our I system would quickly tell us to duck. If we were only using our A system, we would try to rationalize before making the decision to duck. Is the object soft or fluffy, or is it hard and sharp? How hard is the object thrown? By the time we make a decision trying to rationalize, it will be too late. So our I system is designed to make decisions instantaneous. Even if the decision was wrong to duck, it still saves us from potential pain. When trading stocks, we are surrounded by potential pain, which is why our I system is so dominant when trading. Pain from losing on a trade, pain from giving back profits, pain from missing out on a trade. This is why successful trading is so difficult. It's because our brains are not designed to ignore fear. So how can we eliminate fear in our trading? You just have to simply find the high probability pattern, determine and accept the risk before entering the trade, and take profit once targets are met. That's it. If you have already accepted and determined the risk and you know the statistics and the probability of the trading strategy you are using, then what is there to be afraid of? If you want to be a consistent trader, you have to realize that consistency cannot be measured in a dollar amount coming from the markets, because the markets are never consistent. There is no telling how much your winning trade will produce, or even if the market will produce the pattern you were looking for day in and day out. The only way we can find consistency is from within ourselves. If we are consistent at managing our risk and are consistent at only making A system decisions, we will become consistently profitable. Learning to control I system decisions is the hardest part about trading, and it does take a long time to master. In fact, I don't believe it's possible to completely remove I system decisions 100% of the time. They will still pop up from time to time. But by simply being aware of how your mind works and why you make the decisions you are making, you can analyze your performance much quicker and adjust what you need to turn things around much faster. On every trade you make, ask yourself, was this truly an A system decision, or was it actually an I system decision? Once you're good at analyzing these decisions, then your trading performance will start to improve. Most traders don't know it's their mindset that's causing them to lose, and instead they focus all their attention on the markets, when in fact the market is not the problem, it's the trader. And not realizing this will be a never-ending struggle that will never lead to profitability. I hope that you all learned something, and I want to thank you so much for watching.